Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here, Curtis Scouten, jumping into the charts on this August 19th, wrapping up the week on this lovely Friday. And what a lovely Friday it was for our accounts, our trades. Congratulations on the three double-digit swing trades we closed out. We closed out our GME short, we covered our net short, and we also covered our Shopify short, all for double-digit gains. And then in the day trade room today, oh my goodness, it was a very, very profitable day. I actually issued two day trade alerts to everybody who should have been able to capture those day trades along with us, and we scored massively on all of the trades that we entered. I only issued two trades to the chat, day trades, but I went 4 for 4 myself in the day trade room, as well as those 3 swing trades closed. That was a beautiful, beautiful day. And as we start to see these indices roll over, let's discuss why they're rolling over and the particular importance of this weekly signal, which we now have another weekly candle formation. So overall, intraday action on the S&P 500. Weakness right away in the pre-market, massive gap down, and then you tried recapturing some of those gains that you lost. But you notice where you kind of recaptured to these major resistance points over here, failed to basically hold that level and started making new lows with minimal bounces in between, new lows, minimal bounce, new lows, and you just ultimately were chopping on this support zone, this intraday support. You can see this parallel channel connects a pivot high to your pivot high, and you now have a pivot low to your pivot low to your pivot low. That being said, there is a chance that now we should eventually at some point test this area to come up and fill this gap. I'm a big proponent to price action not leaving gaps unfilled. Typically gaps do get filled. There's about a 90% correlation with gaps being filled at some point in time. So I do think in the short term there is that potential we can float up on light volume, but that being said, there's still some weakness now that we have to analyze because there's certain strengths across the yield market and the dollar market. So overall, there's a gap fill down here now around this 420, which could coincide with the move down next week, Monday. And then eventually, once you fill that gap, the question is, are we going to get a little bit of a relief bounce to potentially fill this gap up here? So keep in mind there is a tiny gap to the downside, which we're very close to. You will have the initial support at that 50% retrace as well. Overall, I do think these markets are done. They've put in a potential top, and it's only a matter of time before we start heading much, much lower and creating some real technical damage to potentially test those lows. I'm just going to erase all of these lines here. And just to bring you back to perspective, I'm going to flip to the 30-day charts. This is just a powerful wedge formation where we had a pivot high into where you look like you had a little bit of a breakout. It was a fake out, ended up failing. Look at this beautiful bear flag. You created that bear flag only to open and gap lower to fill this price back up here with this gap fill. But it just shows you the power of wedge formations. And typically a lot of people think upsloping wedges tend to break out, but the majority of upsloping wedge formations tend to break lower, and that's certainly what we're getting here. So if we flip to the daily chart, again you can see that wedge formation, which was clearly broken. It's a thing of beauty when you see the 200-day moving average acting as resistance, and then it also coincides with this downsloping trend line connecting pivot to pivot to pivot. And now the big question is, where's our massive support going to be? We've been touching that. I do think eventually you come fill this gap here at 411. I do think you potentially get a bounce there, potentially something like this where you get a little bit of a bounce. You could potentially try to test that double top, and it would make sense. Sorry, I just erased my lines there. And then it would make sense to maybe test and fill this gap, but ultimately I do think you're going to eventually fail and head much, much lower on the chart. So inevitably with light volume, we should anticipate bounces along the way. If and when that volume starts picking up, preferably in the fall, those bounces might not be as robust due to the fact that we are still technically in a bear market, and you can see there's resistance here. So I'm just going to erase a couple of these lines, this wedge formation here, just so we can analyze the SPY again. overall, if we flip to the weekly chart, because we do have a weekly signal, look at this beautiful reversal candle. So that is something to truly note. There's going to be massive resistance now that you have a weekly, basically a weekly, I wouldn't call it a topping tail, but some would, but it is certainly a strong reversal signal. The volume today on the daily chart actually supersedes, it was 67.9 million, so very, very light, but it actually supersedes the last 6 days of price action. So if you flip back to the daily, just this simple down candle supersedes the last 6, supersedes all of this price action. So that does favor that we should at least head to this 50% retrace, this white line. So if we look at the NASDAQ chart here, you can clearly see that this was resistance, and it looked like you were breaking out of that resistance only to now retrace to that zone and close below it. So analyzing the NASDAQ, usually we look at the QQQ. There was pretty light volume on the Qs as well, but it did supersede again the last 6 days of volume. So overall, I do think there's going to be some downside in the Qs, especially as rates hit. Where I'm anticipating is that we find support here. Basically, I think that's going to be a healthy pivot zone over there as the Qs come down and fill this gap around just below 13,000. So ultimately, I do think you get a small bounce at that level, but I do think that it should be a decent level of support for a short term, maybe a couple day bounce before we inevitably start heading lower. That's kind of my perspective. And one of the reasons I'm so adamant on why the indices are starting to roll over sooner, even if we look at the Russell, which typically has a leading indicator, look at this beautiful reversal signal on the weekly time frame. Many stocks are putting in actually harsher reversal signals than that. But simply why I'm so bearish on the equities is for one reason. If you look at this, the DXY, the US dollar, it has been on an absolute surge, and we were kind of prepared for this. We did say that we are anticipating a surge up in the dollar, at least maybe to this double top zone, or more for that matter. And that's certainly what we've seen. You can clearly see that this was an initial pivot zone that we were trading in, doing a little bit of bullish consolidation. You hit these major pivot zones over here, and you bounced up and you broke out of this down sloping pattern over here. At the moment, you are into short-term resistance, but it's not going to keep you there for long, especially if you factor in why the US dollar is up. So there's a couple reasons as to why the US dollar is up. If we simply look at the yields were on a tear. Looking at the US 10-year, this is why we dumped our UBT bond play, because we were anticipating yields to actually make a move up. And I don't think yields are done. I think yields are actually going to continue to surge and recapture this 3.1% mark. You might find some resistance there at that point where you may be able to retrade back down to the 2.8. But for the interim time, yields are kind of making a short-term breakout, and you have to respect that there is an upside bias favoring the fact that the Fed is likely to continue raising rates more aggressively than what the market was initially anticipating. And this is the type of thing you have to remember. Everyone was so dovish on a Fed pivot so quickly because inflation went from 9.1 to 8.5. Give me a break. If you think the Fed is going to pivot because inflation has potentially peaked in the short term, it could start rearing its ugly head, in another 6 to 12 months when, the likes of the U.S. government run out of oil from the SPR and they start having to actually let inflation run. Right now, they're still stimulating, in a way, fiscal stimulus, because they're releasing all of this oil that we've been accumulated over the years in events of crisis, and inflation is not a crisis that should be dealt with using emergency supplies, in my opinion. But nonetheless, it is what it is, and I do think that inflation can come roaring back, which is why we're starting to see yields pick up, and especially when you look at the inflation that's roaring back in the Eurozone. I mean, with Germany's inflation and PPI number coming in at 37.2%, which is just utterly ridiculous. How can you operate a business when inflation is that high? Your energy costs are just going rampant. All your margins are being squeezed. So the fact that the largest economic engine in Europe is going to be facing, businesses where they have zero margins, their margins are compressed, is certainly going to put them into a recession faster than most people think, in my opinion. And honestly, it doesn't take very long for an inflation rate of 37% to start working itself through the system, especially since consumer pricing can't really adapt as fast as what inflation can typically uptick. And we'll see what happens with this energy crisis. But yields are clearly breaking out. I mean, if we look at the UVT play that we offloaded not too long ago, we offloaded all the way up here at this 34.90, and basically we could buy this again already at an almost double-digit discount, so 9-10% discount. Where do I think the UVT I'd be comfortable going? I think it's this gap fill around the 30.12 level, 30.15 level. I think that's going to be a healthy area again to buy, and then potentially we can start to look to re-examine where the yields may go. But I do think eventually that, you know, that 3.2, 3.5 is probably going to be the ceiling on yields, just due to the fact that it will crush the overall equity and economies. But with the DXY surging, it's going to put pressure on everything, commodities and everything to a whole. But looking at the WTI, so oil actually finished down on the day slightly. It was it was up and then it was down, kind of this whipsaw price action. Overall, you're still at support, but you are starting to make bearish consolidation, which does favor yet again another leg lower on oil if that comes to fruition. Analyzing natural gas, let me just pull up the natural gas chart over here so we can take a look at what that's doing. Obviously, this is the hot commodity. You still had a little bit of a retrace of yesterday's, downside move. Natural gas did finish slightly up, about 1% on the day, but nonetheless, I still think natural gas is heading lower just due to the fact that you've had two reversal signals. Yes, you did close higher, but you still technically got that confirmation signal, which should carry the prices lower in the short term. And honestly, whether or not we stay in it for a big drop or even just, a drop to 756, we'll still be able to make a double-digit gain, even if it drops to 750, the 650 area. So we'll just have to hang tight and see what that does. If we look at the ITB, the home builders, they're kind of a good leading indicator for the economy, in my opinion. If we look at the weekly chart, you can see we ran into this parallel downsloping resistance channel, and it acted as a thing of beauty, massive reversal candle. The interesting thing about this is that you made a new high in the week, and then you've reversed and closed below yesterday's or last week's lowest weekly close. So that is a short-term negative for the real estate sector and for the overall economy, because generally home construction is a massive leading indicator for the overall strength in the economy. Typically, if real estate and home builders are declining, it's going to add a tremendous amount of negative downside pressure to the indices. So we'll just have to monitor that. We are short ITB, so inevitably I do think you can potentially test this double bottom for yet again another double bounce, and then potentially start rolling over and making lowers. My downside target on ITB, I think we have to go down here around this 36.10. There's a massive weekly gap on the chart that I do think should be filled given over the next at least say 3 to 9 months of price action. Let's take a look at a couple other things here. I'm just scrolling through my charts. Gold obviously had a nasty down day just due to the fact that the US dollar is surging tremendously along with yields. So typically gold does see downside pressure in option X. 1, 2, 3, 4, 5 days of downside. Short-term gold is getting into that oversold category. You do have support here. This is your previous breakout channel. So it's naturally when you break out of an area, which we did over here on an impulse move, it's natural to see a retrace back to that original breakout area. So there potentially on Monday could be another little bit more of downside in gold, which could correlate with a little bit of an extra surge in yields in the dollar. And then we look for a potential bounce in the gold market, just due to the fact that I think you still are holding a little bit of a bullish pattern. If you flip to the weekly chart, it's not good that you've pretty much engulfed this candle and this candle the last 2 weeks of price action. But if you can hold this level, the 1740 level, then gold still has a chance to potentially move higher. We'll just have to wait and see. Basically, the DXY is going to be the biggest catalyst for gold. Let's take a look at some of the big movers today. Let's take a look at Bitcoin. So Bitcoin under tremendous pressure. This is why we have been. So looking at Bitcoin's under tremendous pressure. A nasty sell-off for Bitcoin currently actually happening right now. It's down 9.81%. Nasty sell. You can see 1, 2, 3, 4, 5 days of selling triggered a massive move. You are coming into short-term support around this, this parallel channel over here, which could be a buying opportunity. I may consider buying basically where we re-entered around this 20,400 level. I might let it pierce slightly, but overall you're coming into support on a little bit of a nasty downside pressure, and you are short-term oversold. So there is the potential that we could pop a little bit and recapture a little bit of a technical bounce, just due to the fact that you've had a nasty sell-off over the last 6 candles here. And basically when this ends in 43 minutes, you're on a time count, 1, 2, 3, 4, 5, 6 candles. The 7th candle is very likely to be a positive one. It's just a matter of how big is that bounce going to be. If we look at the weekly candle, this is not a good chart, because here I'm going to outline what has happened on a weekly basis. So looking at this blue line, it's the weekly 200 moving average of Bitcoin. Let's simply take a look at what has transpired. So you had your original rally, did not manage to close above it on a weekly basis. Then 4 weeks ago, you managed to close above it on a weekly basis. The bulls would have been looking for confirmation on a weekly basis above this previous candle wick high. You failed that, so now confirmation has to wait another 2 days. Here, you basically rallied a little bit higher, but still with inside of this wick. So again, that's no confirmation. And then you failed this confirmed move. So biggest moves come from failed patterns, and you failed confirming above this 200-day moving average on a weekly basis. So this is a big weekly time frame pattern failure. So it does suggest that we should likely respect that there is potentially more downside. And for all I know, this could slice through this parallel channel of support and come to test this double bottom around 17,000. It's certainly a likely scenario that could happen, just due to the fact where the US dollar is, interest rates are, and overall I do think as we head into the fall period, it's certainly going to favor more an increased volume, where if investors are panicked and spooked, and we may see that with a rising dollar putting so much liquidity pressure and yields putting so much strain on assets, specifically the risk assets, then it's going to certainly provide a lot of opportunity to the downside. Overall, this is a bear flag pattern that potentially could trigger. Just like we saw here, you had a bear flag pattern which triggered to the downside, led to 9 or 10 weeks of consecutive selling. So that is something we have to take note. Basically, this is not looking good, because this is a bear flag, and if we start to break key supports here, the probabilities do open up the fact that this next down leg may be commencing sharper than and quicker than most people anticipated. So let's just be ready. There might be a trade alert in Bitcoin just due to the oversold nature on the daily chart. I do like this pattern that's heading in, but I would want to wait a little bit lower and just to see if we can start accumulating a little bit of a crypto position to catch a little bit of a bounce trade. Maybe it's only going to be 8 to 10% or so, but let's see if we can manage to scalp out a trade there. So overall, congrats on many of the trades. We did fantastic today. Let's keep in mind that if the US dollar continues to surge, basically all equities will start to head lower. And I think analyzing yields, making sure that if they recapture key levels on the next weekly basis, then we have to anticipate that the markets are going to sell off sharply, just due to the fact that conditions are tightening and monetary policies are constrained, and basically borrowing money is more difficult, which puts a strain on the overall liquidity. And that's all that markets are about. Markets are about liquidity. When interest rates and yields are rising, liquidity is strained. And if we look at the bond market is not signaling healthy things. We were touching base on that divergence between the SPY and the TLT. So that's the 30-year bond. And basically, whenever they diverge, one of them is going to have to catch up with the others. And in this case, it's looking like the SPY, because it's diverging to the upside, it's looking like the SPY is more likely to fall lower. Whereas it's unlikely, just due to the inflationary backdrop, yields are going to drop suddenly, which spikes the bond prices and causes the TLT to closely converge with the S&P 500. So I still think the S&P 500 has to drop to converge with the yields price and with the bond levels. So overall, more downside in the short term, in my opinion. And it was just amazing that we have been able to capitalize on such big profits this year, and let's continue to trade smartly, wisely. I think the macro picture is still pointing to many downside moves, and that's certainly what we're positioned for. So congratulations. Take care, everybody. Enjoy the rest of your weekend, and we'll see you on the charts for Monday. Please give